Welcome back to another episode of attempting to turn 10k to 100k over time. So this is my portfolio as it stands, right? I haven't bought anything yet because I haven't really found any opportunities in the market right now. So I just wanted to make a quick update, midweek update of what happened this week and why my view of the market has slightly changed from the video that I released last Sunday, where I talked about how I am bullish going forward. But just wanted to make a quick update after what Jerome Powell has said yesterday in his speech, right? So I'm going to take that into account and change my view of the market. So I believe that as investors, right, it's very important for us to not have a bias and be emotionally attached to any market outlook and view that we have. We are not the market, and we should always change our opinions and biases based on what the facts present to us as of now. So unless you are a very, very long-term investor where you just invest in index or you invest heavily into companies that you are have a lot of high conviction on, I think that's fine. But as for me, because my account is only 10k in size and I'm attempting to get abnormal returns, right, I have to do a lot of market timing and attempt to catch the bottoms to trade and sell the highs, for example. Even for my convicted names, right, I have to do a lot more entry and exits. I have to take a lot more risk. So let's get to it. So let's talk about the Fed, right, and the path until today. So as you all know, the Fed only cares about two things, which is the job market through your unemployment rate and the inflation rate, how expensive things are getting. So let's do a quick typo here, key data review. Let's do a quick key data review of where the economy, the job market, and inflation stands. So if you look at the data here, right, you can pause the video, take a look at the data, but I'm just going to sum it up very quickly, right, which is that the job market, right, we are seeing some short-term weakness in terms of new jobs being added to the market. We are seeing your non-farm payrolls, unemployment, non-farm unemployment missing forecast, but that said, the unemployment rate in general is still very low historically. And if you look at the economy, right, it's fairly resilient and slightly mixed, but the services aspect of things are very resilient, right? It's still showing a lot of steadiness and strength. But if you look at inflation, it's sort of weakening over time. But that said, it's showing a lot of stickiness and it's still above the Fed's long-term target of 2%, right? It's been above for the past 4 years now. And now it's about like the high 2s and low 3s, ranging about there. But we're seeing it slowly grind towards 2% over time. So this is how the economy stands as of now. So you need to note that employment, while it's showing short-term weakness, it's still very low, right? Inflation, it's sticky, it's getting better, but it's still above the Fed's long-term target of 2%. The economy is showing fairly mixed results, but it's still fairly resilient, all things considered. So let's talk about what happened last week. So the Federal Reserve cut interest rates by 25 basis points, citing weakness in the job market as being of paramount importance to tackle right now. They're seeing some weakness in the job market, which was evident by your non-farm payrolls, the ADP non-farm employment data over the past couple of months. So because of that, they are looking to cut interest rates, whatever they have already cut, right? And they are leading towards 2 more rate cuts this year. But just a question and to think about, right? A thought to ponder, which is that based on the data above, does it actually make sense to cut, right? Your employment rate is still very, very strong. The economy is still okay, and your inflation is still fairly sticky. So theoretically, right, there should be no room to cut because it could boost inflationary pressures, and there is still the big question mark of the tariffs impact. So what Trump, everyone, and even Powell has basically aligned on is that the tariffs impact may be one-off in nature, but is it truly one-off? So it's only been like a couple of months since the tariffs are fully enforced, right? We don't know. We don't really have enough data points to see how the tariff impacts are going to play out in terms of inflation. So by right, there should be no room to cut. But maybe Powell has been, very, very pressured, politically influenced to cut. So I think if that's the case, right, the Fed's credibility and independence could be put into question. So as of now, it's still fine, but longer term, let's see how it will play out. But this could also mean that if the Fed cut rates right now and it's continue to cut, it could mean a weaker dollar. And a weaker dollar, if you understand economics, would help to push your inflationary rates upward as well. There will be some upward pressure. So if there is more money supply flowing to the system, there is a weaker dollar, and there is the one-off, well, I wouldn't say one-off, but like the tariffs impact on inflation. So theoretically, you should see an upward pressure on inflation, which is what the Fed doesn't want. But at the same time, it is cutting. They are cutting because they're seeing some short-term weakness in the job market. So just a thought to ponder, right? But all things stands, it should still look bullish for risk on assets. But whether if inflation comes back strongly and the Fed starts to U-turn again, then that may be where the risk on assets may see a trend reversal, for instance. So let's talk about where the market is today. Reasons to be bullish and to be bearish. So we are entering a rate cut cycle. So we already cut once last week, and the Fed is but the dot plot projects like maybe 2 more cuts this year. So we are going to see increased liquidity and flows to risk on assets. Inflation is somewhat acceptable for now. As I mentioned earlier, it's in the high 2% now and it's grinding downwards towards your 2%. Right? It's still within the acceptable range. Earnings are great. So if you look at the past big tech results for the past quarters, even the most recent quarters, they're doing very well, especially big tech. Right? So this helps to enforce the narrative of saying you should lean long towards your tech companies, your Nasdaq companies, which is carrying the entire index right now, right? So all of this, the narrative still plays out, and especially since their guidance is so strong, right? And number 4, the economy and job market is doing fine for now, right? And then now we look at the reasons to be bearish. So I wouldn't say exactly reason to be bearish, but reason to be cautious for now. So number 1, valuations are sky high. So if you looked into my weekly market outlook video, right, you will see that the Shiller PE ratio is very, very high. I think it's at one of the highest points it's ever been. And PE ratio, I think it's near a local high. Price to sales ratio has breached out to all-time highs. So we are in a very high valuation territory. And like I mentioned earlier, there should be some uncertainty towards inflation going ahead with all your inflationary pressure from a weaker dollar, your tariffs, and also your just interest rates being cut, right? And number 3, the markets are pricing rate cuts to perfection. So if you look at the countdown to FOMC tool that I use, right, from provided by the, let me just show you, right, countdown to FOMC, the Fed Watch tool provided by CME Group, you will see that markets are aggressively pricing 2 more rate cuts for the year. So yeah, if anything happens, right, we're starting to see more inflation numbers starting to tick up, or maybe it's being more resilient and sticky. Well, we're gonna obviously see some pullbacks in the market, right? Because it's just gonna create more uncertainty going ahead. So these are my reasons to be bearish. Well, obviously the reasons to be bullish is a lot more stronger than to be bearish for now, right? Because we don't know how high your valuations can go. We are entering a rate cut cycle for now, and even if the Fed would deviate from their current path and do U-turn back to maybe having a more hawkish stance, right, it wouldn't be in the next couple of months at least, because they Powell likes to see your data. So, and to see your data, it takes a couple of months at least. So probably the market will still hit higher for now, but there is still some uncertainty for now. And let's talk about what happened this week. So I think just yesterday, right, Powell spoke and he said something that's quite interesting. Equity prices are fairly highly valued right now. So it's quite an odd comment for the Fed to say, because I don't think they should be involved in the financial markets. They should only care about the job markets and also the inflationary numbers. So given that the Fed commented about this, and they also said that they look at financial assets value as one of their proxy indicators, right? Them saying that equity prices are fairly highly valued may, inject some uncertainty and fear into the markets, right? But it may induce some of your market participants to start, maybe taking profits to rebalance or reallocate their portfolio. But then there's a question: where can they actually reallocate their 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 flows and liquidity to, right? Besides stocks, because you're cutting your interest rates right now, your yields on your treasury, your bonds, all that may not be as attractive as before. So this is a question for your fund managers and for you to decide on how you're gonna rebalance your portfolio. But for me, I think if you're investing in high growth companies, right, it should still be okay, in my opinion. And maybe Bitcoin is something interesting as well, right? Because if you are entering an environment where it's probably potentially a little higher inflation and cutting of interest rates, your safe haven kind of gold and Bitcoin assets may probably see some upward price pressure from your flows towards this kind of asset classes, right? So for Boyle to make this comment, it's quite odd in my opinion, but let's see how it goes. If it's really truly highly valued, then probably we will see some correction, right? Number two, he also mentioned that near-term risks to inflation are tilted to the upside, and risk to employment is to the downside, a challenging situation. So they said if they ease too aggressively, meaning they cut interest rates too fast, we could leave the inflation job unfinished and need to reverse course later to fully restore the 2% inflation. If we maintain restrictive policy for too long, the labor market could soften unnecessarily. So inflation meanwhile remained somewhat elevated, with tariff driving goods prices higher. While the impact will likely fade, he said it will take time, and it was up to the Fed to make sure that this one-time increases in prices does not become an ongoing inflation problem. So basically, he said that there is room for rate cuts, but not without risk. So again, like I mentioned in the previous video, right, what the market wants is certainty, which he sort of provided in his announcement and statement when he cut interest rates. But yesterday he came out and said this kind of stuff, injected some form of uncertainty to the market, which is why you are seeing for the past few days there is some weakness in the market, like there's some creeping fear and things like that. So what now? So if you look at this quadrant, right, which basically shows the Fed's balance sheet on the y-axis and your interest rate on the x-axis. So the best moment to invest, right, is when financial conditions are the most liquid, where your balance sheet, the Fed's balance sheet is high, meaning they're adding into their balance sheet, and when interest rate is low. So this is the best time to invest for risk on assets. Today, right, interest rates are starting to go down, so we're seeing a movement towards C, but the Fed's balance sheet is still sort of contracting. So if you look into let me zoom in so you can see closer. The US total assets held by the Federal Reserve Bank. So for this, right, the chart is still going downwards. So we are sort of in like a C situation, right, in between. And coupled with the whole idea that valuation is still sky high, it makes sense for us to be a little bit cautious. Like we shouldn't just go all out and invest, right? So, and then lastly, right, politically, it still feels fairly mixed. But like I mentioned before in all my videos, that politic events could be like a double-edged sword, right? It could give you the opportunity to invest, especially if it's those short-term, extreme, highly induced fear, like your wars and things like that, which wouldn't really impact the business of your invested company, right? Your company's with high conviction. It could be a time for you to invest. And I think another thing to ponder is inflation, right? There is some upward risk of inflation, like I mentioned earlier. So right now we are at C, but if inflation proves to be not one-off, the tariff impact is not one-off, your weaker dollar is adding to inflationary pressures and it's still cutting interest rates, it may cause the Fed to move from your C area, your A to C area, to maybe towards somewhere near to the middle, which is sort of like a neutral situation if you think about it. So which is why it feels neutral to me at the moment, right? You shouldn't aggressively buy into the market, but at the same time, you shouldn't sell your positions like that. So I think if you are well positioned, you're sitting in the green. I think for me, if I were you, I'll continue holding on, but I will not look to aggressively buy. But for me, right, if you look at my portfolio right now, it's completely empty. right? So I think what I will do now is to slowly add into positions where I feel that there's value, looking at some stocks at the moment, which I will share in my next video, and maybe even like an exclusive one-off video for some of these companies that I'm putting on my watch list. So for now, what I will do is I wouldn't buy aggressively. I will instead take like little buys here and there to test the market, test my my emotional state when holding into this kind of convicted names in this kind of market environment. But I wouldn't aggressively buy lah. So waiting for more opportunities for the market to pull back heavier, like something you might see in October. Well, I wouldn't say April because that was quite an extreme case, or maybe like your couple of months before where you see some pullbacks in the market, right? So waiting for those opportunities to buy. Maybe if we see like a 5% pullback in general index value, I may enter some of these positions, but I wouldn't enter aggressively at one go. So this is my take from the markets for now, and thank you.